Welcome to the Tokenomics DAO podcast, where we explore everything tokenomics related, ranging from deep dives on the tokenomics of the newest protocol to demystifying the nuance of building a successful token ecosystem. Our goal is to bring awareness to the importance of tokenomics and the crucial role it plays in defining the success of a protocol, helping make tokenomics relevant for everyone, builders and investors alike. I'm your host, Flo, joined by my co-hosts, Jason and or Lovis. Welcome to the podcast.
Welcome to episode 27 of the Tokenomics DAO podcast. Today with Rockwell Shah. My name is Lovis. I'm your host today. Rockwell and I met on a Twitter space where we were both invited to discuss tokenomics. I think it was like surviving the bear market or something like that was the title. I was very impressed with his knowledge, especially relating to tokenomics of NFTs or NFT-based projects, something where I don't actually know a whole lot. So I wanted to bring him on and just have a cool chat about the tokenomics of NFTs and like what's going on in that space in general. So first of all, Rockwell, please do us the honors and introduce yourself.
Well, Lovis, thanks for having me here. Excited to chat. It was a fun space. I don't know, it was maybe 3 months ago, something like that.
I think
and,
so.
It's interesting. I never thought my economics degree would ever be as useful as it is today. And, the things that we were studying back in university, most people wanted to go into investment banking or maybe the public sector, but nobody ever thought like, oh, we're going to be designing economic systems in this new crypto metaverse, type thing. So it's hilarious how things work out. And, for me, I graduated in economics from Cornell University, and I spent the better part of 10 years actually not utilizing my econ degree. So I was working in a medical software company called For Patient Care. I started in that business as a very lowly tech support agent, like literally doing screen shares with doctors and fixing their medical software, and eventually became president of that firm. And 10 years in healthcare will teach you, it's just like all sorts of things that are wrong with people. And very much one of the things at the top of the list was sleep. And so after we exited For Patient Care, I founded a company called Pizziz, where we make a suite of digital health apps that help people beat their insomnia, depression, anxiety, stress, chronic pain, and a whole host of other things. And so that business is doing pretty well today. But, right around I want to say like May of 2021, roughly, maybe April-ish, I started really getting into being a DeFi degen, like pretty hardcore. I bought, like years before, I bought Bitcoin and Ethereum, but like 2021 for me was like, hey, there's all these like DeFi protocols. Let's play around. Let's see what's going on with this decentralized finance, and got into some interesting protocols and some interesting adventures. And that eventually led me to founding Starship Guild, which is one of the largest blockchain gaming guilds in the world. And so there's a whole sector of the crypto economy in the metaverse and blockchain gaming, and new business models are popping up. And so we created an organization there, scaled from like 0 to over 2,200 staff in 6 months. It was crazy. We were growing really, really fast in 2021. And it was through that experience that I discovered, man, Web3 is really hard for people. Like understanding these concepts of, oh, I have to self-custody and this wallet, and I connect it to this dApp, and how do I even move money around? And you can see just how much friction there is. I remember I would screen share with my friends, and I would like do a Zoom screen share with their phone and be like, hey, okay, tap this, then do this, then paste this. And it was just so bizarre to people. They didn't really understand. They didn't even have the mental models to really understand what was going on, right? So that led us to founding a school called Invisible College, where we help people learn, build, and invest in Web3. And the school has thousands of students, and it's been a really great, wonderful community. Like one of the things I love about Invisible College is that when you go into the Discord, rarely will you ever hear anybody talk about prices or floor prices or like when Moon or when Lambo or like any of this nonsense. Like people there are really interested in the technology and in building interesting applications and actually delivering value to the world, which is, it's like, oh, delivering value, like what a crazy concept that is, right? So that's a little bit of oh, and I forgot to mention that as part of Starship Guild, we launched a metaverse DeFi protocol and raised about $2 million in 3 days. And then with Invisible College, we raised about $500,000 for the school through selling NFTs.
Really cool. Well, awesome for this super like concise and emotional roller coaster of an intro. So just really quick, one thing you mentioned in the beginning, you really made it from like tech support to president in 10 years or a little less, I guess?
Yeah. So it took me, I graduated school in 2010, and by 2016, I was president of the company.
Amazing. I mean, I think that will be worth a episode at some point, but probably not on tokenomics.
maybe a different podcast you start.
Yeah, cool. All right, awesome. So, okay, you told us about Starship Guild and Invisible College. So, fun fact: I actually just recorded first section of tokenomics education as part of Tokenomics DAO earlier today.
Oh, nice.
So yeah, for sure. So a lot of what you said resonates with me strongly. People need to, they need to understand how it works and like kind of understand the nuts and bolts, right? And the cool thing is when you do build a community around this idea of deeper understanding, you attract really awesome people, right? I mean, this kind of resonates what you were saying on your Discord. Nobody talks about when Moon. Yeah, value creation at the core and like figuring out how to make these things sustainable, I think is on a lot of people's minds, because just pump and dumps are not gonna get us there. So
turns out Ponzi's are not sustainable. I think Web3 has a golden rule, and the golden rule is actually pretty straightforward. It's that value should accrue to the network of participants based on the value of their participation, right? So it's like, hey, the more you do, the more you're going to make, right? The more you show up here and the more that you contribute, the more that you will earn, or more that value will accrue to you. And I think that is really the golden rule of Web3. Everything basically flows from that. And if you understand that to a really deep level, you'll understand what Web3 is trying to accomplish. And I think, I was giving a talk the other day, and it was an intro to Web3 talk. And people, these were marketers, these were people like career professionals that were really interested in getting into Web3, but they wanted to understand how to think about it. And I gave them like the lay of the landscape, right? Like the introduction of like, okay, what is crypto? What is tokenomics? What is all of this stuff? What are tokens? How to think about this? And ultimately, what Web3 is a set of ideals. It's not like Web3 is not a thing. It's a set of ideals that we hope to aspire to. We hope that, we can turn more people into owners versus renters. We hope that we can, build systems that are much more decentralized and tamper-proof. We hope that, we can accrue value to people based upon the value of their participation. Like we hope these things, but they're not real yet. Right. And to like delude or fool ourselves to believe like, hey, the dream has been fully realized. Like it's rainbows and sunshine and flowers. It's like, no, it's not. Right. But that's the journey that we're on. The reason that so many people are excited and the reason that so many smart, interesting, engaging people are building in Web3 is because they want to live up to these ideals. They want to live up to this new future. And there's no guarantee of success, but it's, for many of us, we think it's better than what exists today.
Yeah, completely agree. So we're going through exactly the same evolution, I guess. So, as being part of building a DAO myself, figuring out how to reward value creation is actually really difficult, right? Because you need to track all kinds of metrics, but like then it's like, is it really trackable? Do you want to measure input KPIs? Okay, so say somebody's in charge of your Twitter account. Do you want them to write 10 threads, or do you want them to write the one thread that gets 1,000 likes? Well, you kind of want both, but how do you measure this fairly? And so there's endless opportunities still in creating the new tool set that people will need, or like organizations will need to do this. And yeah, I think there's a lot of people building that. There's a lot of stuff. We're trying out a ton of stuff, but ultimately we end up making our own like Google sheet because we're more comfortable with it, because it feels it's exactly the way we want it, rather than trying to
Right.
use like Coordinate or Dwork, or all of these are helpful tools and we use them, but there's still some more to add to it. But yeah, exactly. So these ideals that we have, they're not fully realized yet, right? But hey, at least we have them, right? At least they're the foundation that we want to build upon, that we want to aspire to.
Yeah. I mean, having a dream, having a mission, having ideals are important. It's the foundation of what you're building on. If you don't have a foundation, I mean, where are you going to go? Like whatever you build is always going to be on shaky ground. So I think, part of the process of building, and this is something that's really hard for people that are not builders or are not entrepreneurs to understand, is that there's a lot of discomfort that you have to live with day to day in the fact that your dream is not fully realized, right? You basically have to ship products too early. You have to be willing to deal with the embarrassment of putting a first version out there where it's like, oh, this is nowhere near what I imagine it going to be one day. Even at large scales, we're not even talking about like small time entrepreneurs, even at large scales. Do you think that Apple was super happy with the first version of the iPhone? It's like, no, probably not. Like they dreamed of many more things that the iPhone could do one day, right? And so on and so forth with the iPad as well. It's like I remember when the iPad first came out, it didn't have multitasking. It was like, what is this computer device that does not have multitasking? Like, multitasking has been around for like 20 years at this point, and this like basic device can't do it. It happens at all levels of the game, from small to large, is that you have to be, as an entrepreneur or as a builder, you have to be willing to deal with the discomfort of not fully realizing your dream for long periods of time, and talking about what the dream is over and over again, and being willing to deal with all the negative comments that come with people and people naysaying, say like, oh, but it doesn't do this or that yet. And it's like, yeah, it doesn't. It's not fully realized. It's not a fully realized vision yet. So, I think a lot of folks are learning that as we are making more people into investors. Think about the traditional economy. In the traditional economy, you have to be an accredited investor to participate, right? In crypto, everybody participates, or like almost everybody participates. Like even the gas tokens that you're holding, even the Ethereum or the Bitcoin or the Avalanche or the Solana you're holding is technically an investment asset, right? So, you are meaningfully participating as an investor in almost every part of the stack of this new economy. And so it just, I think a lot of accidental investors are getting an education about what it means to be long-term believers or long-term holders, or to buy into a vision of a project, right?
Yeah, so several rabbit holes, right, that you just opened up. So
which
everybody
one will we go down first?
Everybody participates in Web3, right? I mean, the amazing thing, and also like the innovative thing, is that you can actually own the protocol layer, right? So like,
yeah,
with the internet, like you could have bought like Yahoo and Google probably pretty early, and you would have done great, but you could not buy TCP/IP, right? Like the internet protocol, basically.
mm-hmm.
And I think that's so I think that for every flavor of investor, there's something there, right? Because if you're like, oh, Ethereum is going to be the world computer, they're going to do amazing, well, then just hold that, right? You're going to most likely do okay.
In fact, if you had just held Bitcoin and Ethereum, you would have outperformed the vast majority, like 99% of the investors in the market just holding Bitcoin and Ethereum,
Yeah, exactly. And then this other thing, so this is one of our favorite things that we always keep going back to, this principal agent problem, right?
Mm-hmm.
That's what you said earlier, the owner versus the agent, the owner versus the renter. One is trying to make the whole thing a success. The other one's trying to just, I guess, do the bare minimum to not have catastrophic failure. so to say. And the amazing thing about it is that tokens give you a whole new opportunity to create owners, right?
Mm-hmm.
And so I guess, so with that in mind, did you pick up tokenomics, I guess, as a side product of like your involvement in general in Web3, or is this something that you purposely tried to understand? I guess you said you have an economics degree, so it just kind of comes together in your brain, or how do you go about that?
Yeah, it's interesting. When we started the school, people asked a lot about tokenomics, and they wanted, somebody to teach them tokenomics in the school. And so I went on a journey myself of like, okay, who are the best tokenomics thinkers? What's the best material out there? As you said, like, I'm naturally inclined to economics already just because of my background. So picking it up is kind of second nature. And what I found was that there actually are not that many great tokenomics thinkers out there. There's a few that talk about it, but even if you were to try to Google a coherent definition of what tokenomics is, you would not find it. Like, people would say things like, "Oh, tokenomics is the economics of tokens." It's like, "Oh, thank you, super helpful."
Yeah.
And what that means to me is, hey, this is really exciting. This is a brand new, wide open field where you can do interesting work. You can do research, you can do development, you can put out, interesting papers or blogs. And that's what, it got me excited almost in the same way as when they teach us classical economics and they're like, okay, Adam Smith and then the book, and then and then you have like Keynesian economics, and then you have the Friedman people. Like, the history is laid out. The economics history is laid out with really important moments of different movements in economics that color our thinking in the field for long periods of time. And here we're presented at a moment in crypto where we get a chance to do that. We get to define, what tokenomics actually even means, right? Like, what is good tokenomics? What is bad tokenomics? And we get to help discover that and define it and put it out there. And so that became really interesting to me. I was like, oh, cool. Like, finally, all this stuff that we learned at university is relevant here, right? Because they also teach you in economics that, hey, yeah, it's kind of a hard science. It's kind of a soft science. Like, it could be a harder science if only we could experiment or have like large population experiments. But look, it's kind of unethical to force recessions in an economy. Like you can't just play with people's lives this way. So, video games were an interesting tangent to that. It's like, oh, we could test on video game economies and see like these economic theories, how they play out in video game economies. But now we can test them in crypto economies on, large and small scales in ways that are just not possible in the real economy. So in any case, I went on a journey from my very first principles. It's like, okay, what is tokenomics? Like, at its base level. And, to answer what is tokenomics, you have to understand what crypto is. And, like a kind of a shorthand to this is that crypto is programmable incentives. And in crypto, incentives are programmed through tokens. So like, I want you to do something, I'm going to give you a token if you do it, right? And that's like, as silly and simple as that sounds, it's actually magical. It's like, oh, I want there to be a decentralized reserve currency. So if you help secure the network, we're going to give you Bitcoin, right? Or I want there to be a decentralized internet. So if you run this hardware and these nodes, we'll give you a cryptocurrency called Helium, right? Or like, we want there to be decentralized forever storage. So if you run the nodes to store the data, we'll give you Arweave, right? The point here is that all of a sudden, you don't need US dollars or some other, traditional currency in order to reward people for doing a behavior or an activity. You can say, hey, I've made up this token to incentivize this behavior. And if the market thinks that that behavior is interesting and valuable, then the token will have value, right? And if it's not interesting and valuable, then it's not going to have value, right? And so ultimately, what tokenomics is the study of token-based incentive mechanisms. That's it. It is really that simple. It's like, tokenomics, very straightforward. It's like, it's the study of token-based incentive mechanisms. And you can't, like, you almost not find this anywhere on the internet. If you Google around, like, what is tokenomics? Nobody will say this very simple thing. It is so straightforward. But the thing is, like, most people are not talking about it from first principles. They're not thinking about, like, what exactly are we doing here? What is the point of all of this?
Yeah.
What is the framework that's powering all of this activity? So I think once you understand those things, that it's like, okay, crypto is programmable incentives. Incentives are programmed through tokens. Tokenomics is the study of token-based incentive mechanisms. You lay a foundation of like, okay, cool. Like, what else can come after this? Like, what else am I building off of understanding here?
Yeah.
And there's many things that play into tokenomics, which we could talk about, but I certainly don't want to turn this podcast into a tokenomics lecture, right?
No, I think you lay it out so well. And so this is sometimes, these chicken and egg. So I don't know if you gave me this definition and I've made it my own, or if I already had it. but I definitely but this is definitely how I define tokenomics as well, the study of token-based incentive design. That's how I lectured it or taught it earlier today in the first recording.
Yes. Thank you for spreading the good word, Lovis.
I know. I guess so. What somebody had told me, which I think was a really good point, is that so first of all, what you had touched on this beautifully, right? The econ is kind of missing this microcosm to experiment, right? And I think that's why ultimately Web3 will grow at such an impressive pace and innovate at such an impressive pace, because really every single project is an innovative iteration, and then basically we'll copy what works, we'll discard what doesn't. And like you said, yeah, doing that on a large scale economy is kind of tricky because you don't want to put a bunch of people in recession. But then I guess in a microcosm it works because the stakes are much smaller. But then additionally, and well, I guess because of that, maybe tokenomics are more design oriented, right? Like, so I want to get to a certain outcome, so I try to define the rules for that, or the incentive mechanisms, where econ always tries to be predictive, like given a set of rules, what will be the outcome, right? So we have a lot more liberties to experiment too, and with tokens, I think.
Yeah, I think that's a great point. We tend to, in crypto, think about outcomes more, although, I think the rise of behavioral economics was really powerful and important for economics, the economics field in general, and understanding that, look, like, human beings are not that rational. Like, yeah, we're somewhat rational some of the time, but most of the time we're not that rational. And all of these things that you believe, because at its core, you think that human beings are rational, like rational agents in the economy, lead to things that are just untrue in the real world. And so, this has gotten us into trouble in the economics field many times. And behavioral economics is this, in my, at least my opinion, this great field of economics that's like, hey, dose of reality, guys. This is quite different than what you think it is. And human beings behave in all these bizarre ways. Let's understand these ways they behave so we can build better systems that can account for, the unintended consequences of incentive designs, right? So, and we do this, and now we do this in crypto too. Like, we're understanding a lot more of the unintended consequences from various token-based incentive designs, where we can't just assume that people are going to be rational computers. It's like everything is going to be, this way, and it's like that's not how it's going to be, right?
Yeah, but the cool thing is that there are actors in the system that are actual computers. So a lot of stuff can be kind of set in stone, right? It can be put in code, and then those are the rules, more or less, right? Then of course there's mechanisms to change it and so forth. Thinking about the Ethereum merge.
Don't go down the code is law rabbit hole. that's a deep rabbit hole, Lovis.
It's law until it isn't, right?
Yeah.
But one thing that I've found, this is also tricky, right? So I think of tokenomics as more transparent, but that's because I'm part of a group that does a ton of research on this, and we're trying to create a kind of like almost like a standard to documentation. And of course, why do we do it? Well, because it isn't, right? It's hard to find the facts and the figures.
Somebody was just asking me the other day, they were like, hey, do you have a template for a white paper? And, especially the tokenomics section. And I think, in this whole build in public, crypto tends to build in public naturally. It's like you can go to a project's Discord or a Telegram and talk to the team much more readily than you could say, talk to the team behind a public company, right? Like, good luck
Right.
pulling up the New York Stock Exchange, picking a stock, and going to their Discord and asking the team any kind of questions about the protocol, right?
Could I see
So
your financial statements, please? Well,
yeah.
you get the quarterly filings. That's about it.
Yeah, so there's, in some ways there's a lot more transparency in crypto. I mean, in some ways there isn't. Like, there's certainly ways to obfuscate financial transactions and what's going on, but I think net it's far more transparent. Like, blockchain rails are far more transparent than the traditional economy.
Yeah, I would agree. Okay, so I know that you have a deep background, way deeper than me, in this whole NFT space. So that's what I'm trying to kind of pivot into. So, honestly, I don't think so, but many people probably assume that, well, NFTs, right, non-fungible tokens, how can they even have tokenomics? Or like, what, I guess, what are the incentive mechanisms involving NFTs? Can you poke into that a little bit? Because I'm actually super curious myself to learn more about that.
Yeah, so I think we have to start with what's actually happening.
Mm-hmm.
Like, what is happening in the industry? And I think oftentimes when we're analyzing these things, we don't start from this base. It's like, just walk into a situation. It's like, what is actually happening here? Like, what are the incentives that are being played out? I think for people, when they look at the NFT market, especially when they're looking from the outside, the assumption is that, NFTs are about art collection, right? Or NFTs are about utility or some kind. It's like ticketing, or it's like it's the next generation for unlocking some experiences, some utility, some memberships of some kind. And while that is true in some small portion, like, there is a small portion of the market that's interested in art collecting, there is a small portion of the market that are utility based NFTs. The vast majority of the market is driven by the game of NFT trading. And the game of NFT trading basically is the biggest blockchain game in the world. And what people are doing is they're effectively playing poker with non-fungible tokens, where they're trying to outsmart other people and take their money, right? So it's like they're trying to not be the bag holder, and they're trying to make other people the bag holder. And it's this very large, like one of the largest games of hot potato in the world, where it's just like, it's like, no, I don't want to be holding it. You hold, like, I'll hold it for a little while until you think the potato is more valuable, then I'll throw it to you, right? And this is effectively what's happening, right? And you have to understand the mentality of the market participants. Like, there's not that many people trading NFTs in the world. Like, the number of actual hardcore traders could probably be described in the low tens of thousands, right? Which is, I mean, that's a glaringly small number, right? The number of people that have ever traded an NFT is probably on the course of like low digit millions, right? We know from the market that about 92% of the people that trade NFTs are at a loss, right? So only about 8% of the people in the market are actually profitable. And so only 8% of the players in this game are actually winning. 92% of the players are losing, so to speak. Why do I tell you this? I tell you this because in order to design tokenomics, you need to understand the incentives of the participants, right? You need to understand the incentives of the game. If you don't understand the game that's being played, how are you going to design tokenomics around it, right? It's just,
Right.
So the game is not, at least in this stage, at this moment, the game is not about art. It's not about utility at a large scale. At small scales, yes, but at large scales, no. This is also why NFT trading volumes have come down so considerably. If you look at the highs, it's like there was, I think, something like $500 million traded in one day on OpenSea sometime last year. Now there's like, the volume is 99% down from that, like way down, right? Well, why is that? It's partially because the players at the table lost all their money, right? Like if 92% of players are down, right? Where are you going to get liquidity? Where are you going to get money, right? And this is why when you hear about the NFT industry, oftentimes you'll hear, what's the meta, right? What's the meta? Like, it's like, is our Freeman's the meta? Are utility projects the meta? Are art blocks, like generative art, the meta? It's like, what's the meta today? And you would only ask what's the meta if there was a game being played. And again, the game is NFT trading, right?
Mhm.
And so you will also hear people talk about the liquidity in the space. Liquidity. I almost never, like, I'm married to a conservator. She restores fine art. So I have a decent amount of surface area with the fine art world. I generally do not hear people walking around in the fine art world talking about the liquidity of the fine art space, right? Like that doesn't really happen. Like nobody's walking around like, what's the meta of fine art? Like what like what's the liquidity? A Christie's auction, if there's a record-breaking Christie's auction, people aren't mad because it took liquidity out of the system, right? It's like, oh, the liquidity is gone. Again, you have to understand the game that's being played, and the game that's being played with NFT trading or NFTs is the game of NFT trading, which meta matters a lot because it's like, what is the dominant strategy that's going to win? And then liquidity matters a lot because you could only win the chips at the table, right? You can only win the money that's there because it's a zero-sum game. It's basically poker, right? You can only win the amount of money that's at the table. You can't win more money than that's at the table. And so if less money is at the table, of course you're going to get mad because you're like, oh, they drain the liquidity. They drain the money off the table. Like, that's less money I can win, right? So
Sorry, quick question. So the meta is the dominant winning strategy. Is that what
yeah,
that
it's
describes
like,
more or less?
so like the meta is a term from video games, and like meta is the set of strategies that are like the winning in fashionable strategies, right? And so they are kind of the accepted dominant strategies coming from like groupthink of like, hey, this is what our gaming culture says is the dominant strategy of this particular game. Now, it's important to note the meta isn't necessarily the dominant strategy, right? It's what the crowd believes is the dominant strategy, right? And so oftentimes you can win by being a contrarian and being like, okay, there's something wrong with this meta, or there's some hole in it, or some gap in it, or some opportunity in it. I'm going to exploit that. And then you exploit it, and then people get to know that you exploit it, and then your strategy ends up becoming the new meta, right? And it's like all of a sudden, it's like the meta changes. And so with games, meta changes all the time. With NFT trading, because it's a game, meta changes all the time. And so, and because the participants have particularly high levels of ADHD, the meta, is like constantly changing. So that all of this is to give you context so that we can actually talk for real about tokenomics. This is what's happening. And this is also why the projects that tend to be the realest, that are delivering the most actual real world value, are not paid attention to by the market. Because the market, like the meta is not, hey, we care about projects that are actually delivering long-term value, because you're not a long-term holder. So if you're not a long-term holder, why do you care about projects delivering long-term value? All you're doing is trying to convince the next person behind you, to buy this asset off of you for more, right? And so then you get projects that are painting like very lofty visions and dreams, and like, hey, we're going to make a AAA game, or we're, going to save the world from hunger, so like some nonsense, right? And it's like, anybody who has any level of sophistication as an investor can look at the dreams being promised and being like, that is utterly ridiculous. Like, this is clearly a group of like 18 or 20-year-olds that they either they're trying to outright like grift you, or they don't understand what they're trying to develop, or like the thing that they're going after. But anyways, I don't want to dive too much into the mentality of a lot of these NFT project founders, but in any case, that's what's actually happening, right? So like for example, CPG Club. CPG Club is an amazing NFT collection. It's led by Chris Cantino, who has like over 100,000 followers on Twitter, is a popular social media personality, and he launched a collection that's one of the realest collections around. I mean, they're actually really trying to build something substantive, like a real business that's delivering real value, and they're doing it methodically. And what does the market do? The market punishes them, right? So like their mint price for their NFT was 2.5 ETH. I think now you could probably pick up a CPG NFT for like 0.4, 0.5 ETH, right? So it's lost a lot of its value, even though it is quite literally one of the realest projects around. Like, I mean, just like they have an incredible members, they have like incredible initiatives. They started an incubator program where they're literally giving $50,000 of non-dilutive equity to Web3 projects. Like they're doing a bunch of things that are actually real and not participating so much in this NFT trading game, and the market punishes them for that. And that's pretty much true universally across the board. So I think this is the context of understanding what's going on. Now, this is also why you see many NFT project founders being very, very angry when royalties are not paid when people buy and sell their collection. And so, many people get very excited about this idea of, hey, you can embed royalties into NFTs. So like finally artists can get paid, right? Like that's the dream that we were pitched. That was the dream that we were promised, is that, all right, like NFTs are going to make art awesome, because no longer is it going to be, Vincent van Gogh situation where makes incredible art, but, ends up dying penniless, right? Where it's like, finally, you as an artist can continue to make at least some money as your art, as the pieces of artwork go out there and they proliferate in the world and they change hands. Like you're not left out in the dry when your piece sells for $100 million 10 years after you created it, right? That's the dream. But the reality is that it turns out royalties are not actually baked at the smart contract level for NFT collections. So there's not a, and people make this mistake or they have this belief that it's like, oh, it's embedded in the collection itself. It's not. It's embedded in, right now, it's embedded in the marketplaces. So, a marketplace has to agree to respect the royalties of the collection. And now you're seeing marketplaces come out and they say, no, like we're not going to do it. And so SudoSwap is probably the most famous for this. And there's others that have followed suit. I think X2, Y2 also followed suit in SudoSwap. But in any case, you're getting marketplaces now that are saying, well, we're going to let the buyer decide if they're going to pay royalties or not, or the buyer and sellers. And it's like, that's not really going to work. Like you're basically saying, hey, out of the goodness of your heart, market participants, can you please pay royalties? And think about what's happening. Most of the market is NFT traders. NFT traders do not care about the art. They don't care about the collection. They don't care about the long-term interest of the project. They care about flipping. And they care about their bottom line profit.
Well, then it's just extra cost, right?
Yeah. And so now you have this battle between NFT project founders who are saying, we want royalties because that's basically the only real revenue stream that they have as a project, right? And then the NFT traders who are like, I want the money. Like, I don't want to just give you the money, right? So now there's a whole debate of like, well, wait a second, how do people create sustainable NFT collections, right? Like what does that even mean? And I want to pause here because Lovis, this is a pretty deep rabbit hole we can go down. I just want to make sure that you're okay going down this rabbit hole because there's quite a bit more to this.
I love it. Let's go.
Okay. All right. Okay.
Okay, well, I guess but we're firmly in the NFT art space with the sustainable NFT art collection, right? So because I do want to ideally also touch on this NFTs that are like gaming assets, and for a time they were paying yield and doing all these amazing things, right? So I don't know what the market situation is there, but I assume it's also way down. But I am super curious about the NFT art. So let's go, and then hopefully we still have time to touch on the other thing.
Okay.
If not, then we'll just have to bring you back sometime.
Yeah. So this is a really interesting, the royalty problem is a really interesting problem where people are saying like, hey, what are the sustainable revenue streams for an NFT collection? And like the first thing that we want to point out is, okay, this whole game of NFT trading itself is not sustainable. So you're trying to build a business on an already non-sustainable infrastructure. But let's just assume NFT trading was sustainable, right? Would it make sense for royalties to be enforced? And I think that the answer is yeah, because the game is NFT trading, right? And so if the game is NFT trading, then people are going to be incentivized to trade a lot. That's going to generate fees, and then that can go back to the collections. But if you're not in the game of NFT trading, either because people don't have any money to trade, and so they're like the participants have gone down, or because you're actually moving towards a more healthy ecosystem where people are holding the NFTs and not trading because they're long-term believers in the project, well, then you don't have sustainable revenue streams, right? This royalty, this idea of royalty is incentivizing the wrong behavior for building long-term projects, right? You're incentivizing people to trade the asset that they're holding and not be a believer, right? Not be a holder. And so, that there's a very fundamental first principles problem there that I don't think a lot of projects are really thinking about, which can be solved in a number of ways. And we can talk about some of the solutions, but before we talk about the solutions, let's talk about how this works in the traditional economy. In the traditional economy, you start a company, you as the founder own 100% of the shares, right? And then you say you want to do, maybe you take a co-founder, so you split some of the shares with them. Maybe you do an investment round, and your first investment round, we generally call the seed round. So you do a seed round of investment, you take on some investors, you're going to give them some shares, right? Then you do a round after seed, it's called Series A. So you do Series A, you do another investment round, you dilute even more, and you give more shares away. More and more and more, you're diluting yourself, right? At no point, you as a traditional founder, at no point did you think it was a viable strategy to sell 100% of your shares of your company on day one. No company that has ever done this, right? Is like at their seed round, they're like, cool, I'm selling 100% of the shares. This would be stupid. Like you'd be like, wait, what? Like the incentives are way wrong here.
Yeah, you're no longer an owner, right? You're no longer principal. Yeah.
You're no longer an owner. You're no longer incentivized to build the business, right? Why is this so why am I telling you this? Because this is exactly what NFT collections do. On day one, they try to mint out, right? They're trying to mint out their entire collection. And that's effectively like giving all of your equity away on day one, which is just stupid. It's like, it's really, really stupid to do, right? And it leads you into these problems of like, okay, well then how am I going to incentivize people to come join the project as staff, not just as like holders, right? How do I incentivize people in partnerships? How do I incentivize investors? How do I incentivize all the other stakeholders that are necessary in order to make something successful? And it's like, it makes a lot of sense to mint out your collection if you're not really going to deliver long-term value. If the most value that you're going to deliver is on day one, right? And for a lot of collections, that's the truth. The most value that they will deliver is in the hype and the lead up to minting. And then post mint, they don't do very much, right? It's very much the exception, not the rule, that collections survive after the mint and do anything interesting. So, the first thing that NFT collections could do is they could learn from the traditional economy and be like, wait a second, why are we giving all of our assets away on day one?
Right.
And to be clear, NFT project founders will tell you it's because they want decentralization. They're like, no, man, like we have to mint out on day one, so we have as many holders as day one, so it's as decentralized as possible. And then, it's like, then some giant whale can't dump on you. This is the fear that all these folks have, is like, oh, there's some wallet out there that's holding thousands of NFTs on it and is all of a sudden just going to dump on the market and tank the price, right? For the most part, this is an insane belief, right? Because effectively, even if you did have a large portion of the NFTs, if you did that, you would destroy the project, right? Like, it's not in your incentive to do that, right? Like, you're taking like a potentially valuable resource, and by playing your hand that way, you're just crushing the market cap. You're just absolutely crushing the market for this thing, right? And so there are many, many reasons, like any more than a company would take their shares at the seed stage and then fire sell their shares and tell their employees like, well, sorry, your options are worth nothing now because we took all the shares that we were holding and we just dumped it on some secondary market. Like, good luck. Like, no, maybe you could pull out some like crazy historical examples of that happening, but that's like, does not happen effectively, right? And so I think there's so many things that we could already learn from in corporate governance and how organizations actually operate today. And crypto, though, decides that it wants to speed run everything. Like, it wants to speed run the mistakes of history economically, from the corporate governance, monetarily. Like, you pick whatever field you want. Crypto, for some reason, has decided that the best course of action is not to learn from the past history, but just to speed run all of its mistakes. And we just do it a lot faster. Like, we make the mistakes very, very quickly, right? So all that is to sum up is, there are things that NFT collections can do. One of them is hold back more of their NFT. If they believe that they're here to deliver long-term value, then your NFTs should be far more valuable in the future than they are today, right? So why would you sell them today instead of a year from now when they'll be, or 2 years from now, or 5 years from now when they'll be far more valuable? And you can raise money for that. Another thing you can do is thinking about, like, what is actually what business are you in, right? The thing that makes so many people excited about NFTs, which doesn't really exist today, is this idea that I start with a dream. With that dream, I attract a community. With that community that buys into the dream, I could then fundraise through an NFT collection, right? And now I've given my people something that they can identify with. So it's like, oh, they're on Twitter Spaces or they're on social media. Like, we can see that, hey, we're both interested in this thing. It's like, cool, it's a profile picture. It raises funds for the project to go after the mission or the dream. And then it potentially gives some kind of novel unit of influence in that community, whether it's governance or being part of working groups or all sorts of things. Like, it allows you to actually meaningfully participate potentially. That's not like, that's the dream, right? The dream is like, hey, now there's this new way of starting a project that can change the world, where you start with a dream, you attract a community, you fundraise with NFTs, and then you turn into a DAO, a decentralized autonomous organization. And, it's like, the whole point of DAOs is you have people, you have capital. How do we efficiently organize these things to go after some kind of mission out there, right? These are all the dreams, and they're beautiful dreams. And for the most part, they don't exist in real life, right? Like, that's not actually what's happening. The closest I could give you to an organization that does this really potentially well is Nouns. So if you go to nouns.wtf, this is one of the most famous NFT projects in the world. They have an interesting model of sustainability. They sell one noun, that's their NFT, every day. That's their fundraising mechanism, right? So there was no pre-mine, like there was no pre-mine of NFTs. They're selling one a day, and they're basically auctioning that one a day. And then that money goes into a treasury, and then that treasury can be voted on by nouns holders of what to do with it. And it's the closest thing to a real DAO and a real, like the thing that I laid out. It's like, okay, dream, community, fundraising, it's like that is the closest that there is, in my opinion. So you have these different mechanisms that you could, from a tokenomics standpoint, use to help you deal with the fact that royalties are not a sustainable stream of income, right? You can hold more NFTs back. You can auction off NFTs on some cadence. There's many more that we can go into, but for the sake of time, let's stop there.
Is it generally speaking, is it important that NFTs eventually mint out? Like, do all NFT collections have a hard cap, or not really?
Nouns doesn't. Nouns has no hard cap. Yeah. So
Yeah.
I mean, but like the number of nouns that exists is much smaller, right? Like the number of nouns that exist are in the hundreds. Like I think there's less than 500 nouns, where it's going to take them a year to do 365 nouns, right? So just think about, in order to reach 10,000, how many years do they have to? It's like 30 years.
Yeah, it's just interesting because I mean it strikes me that you could really use common key metrics to also look at NFT collections, right? I mean, is it, what's the total supply, what's the circulating supply, what's the total cap,
totally
inflationary, deflationary, and so forth.
So NFT collections definitely have tokenomics in that regard. Like they have the basic, all the basics, like how many tokens are there, who's holding them, what's the distribution. You have the whatever novel mechanics there could be of inflation or deflation. I mean, all that stuff exists with NFT collections, and people look at it.
Are there L1s being developed, or are there any that have this royalty thing mechanism built in on the smart contract there? Do you know?
L1s?
Yeah, like
so
because you said it's not actually part of the smart contract layer, right?
Because it's not. No, it's a good question. I don't know the answer for sure. What I would tell you is my closest answer might be the near ecosystem. So on the near protocol, devs get 30% of the revenue that's generated from their smart contract by default. So that's at the protocol level. I don't know for a fact though how that plays out with NFT collections on near, but I would say if you're interested in diving deeper in that, go look at the near ecosystem, because they probably have the best shot at that being true.
Cool. Yeah, awesome. Do you have a hard cap at the end of our scheduled time? No. Are you down to go into the gaming NFT space for a little bit?
Sure.
Awesome. Well, so from what I've read about Starship Guild, this is I guess kind of the business model, right? Invest in gaming NFTs, many of which pay dividends, or at least can create what do you call it, APY, I guess, by being loaned out and so forth. Is this what Starship Guild does, is try to collect these and then make money off of them, or am I misrepresenting that?
So in 2021, a popular business model in blockchain gaming was buying gaming assets, loaning them out to people. Those people would play the game. They would earn some money from playing the game, and then there'd be a revenue share on the money earned between us and the players, right?
Yeah.
And this was like a really nice formula in many regards, in the sense that the players took no asset risk. They didn't need to start with any money. Like they didn't have to buy into anything. It was not a loan, so they're not on the hook for anything, right? So the guild took all of the asset risk, and the
Yeah.
players could just earn. And for some of them, and some periods of time in 2021, that money was more than they were making in their full-time job. So they were like, wow, yeah, this is incredible,
Play to earn.
right?
Yeah.
And for the guild, it was like we went from 0 to doing like on course to do 7 million ARR in the course of a couple months, right? Like that's unbelievable to build a business that quickly. But what's the problem? The problem is none of it was sustainable, right? The problem was that it was actually just another kind of like modified Ponzi, basically. And in crypto, we keep falling for the same shtick, right? And the shtick happens to manifest itself in different forms. So we kind of get fooled a little while. But the shtick is basically this. It's like, okay, Lovis, you're gonna give me $100. I'm gonna give you $1 a day. Now, in the beginning, you think you're a genius. You're like, oh my God, I'm making 1% a day on my money. Like I'm Warren Buffett. I'm the smartest financial guru on the planet. And so you start feeling really good. It's like day after day, you're getting $1, $1. You're like, wow, this is great. Like pretty soon I'm gonna be a millionaire, right? And then even for a period of time, it's like you start telling your friends and people get excited and then they buy in. And then maybe that $100 you invested, the principal like shoots up. All of a sudden it's worth $200 or $250. And maybe your passive income off of that ends up going like $2 a day. And you're just like, man, I am crushing it. Like, this is unbelievable, right? And the hype builds and more people buy in. But what happens? What happens is that it's not sustainable. Like, I am just giving you a portion of the money you've already given me, right? Like, I'm not actually going and making money in any kind of sustainable way. You gave me $100 and I'm just paying you out of that, right?
Yeah.
So eventually what you end up seeing as time goes on is that the thing that you invested in $100 that shot up to $200 eventually goes and dips below 100. It's like, oh, it's like at $80 or $75, and you justify it to yourself. You're like, well, I've been making this yield, this $1 a day, so like if I add up the yield and I add up this principal, I'm still in the positive, I'm still in the green. And so you hold on, and then what happens? It keeps tanking, and your $1 a day that you were making goes to like 5 cents a day. And the original asset that you were holding ends up going to like $5 or $3, right? And you look back on it and you're like, wait a second, I gave $100. And when I sum up everything, I've only like gotten back $50. So actually I've lost half my money, right? It's like, here I was this great financial genius. I was making all this money, and somehow I've ended up with half the money I started with. Does this sound familiar? It should sound familiar because like in crypto, we call this the node system, right? So if you look at the node model, like Strong, for example, this is exactly the node model. This is also the model for yield farming and liquidity mining. This is also the model for blockchain gaming. This is also the model for so many other things in crypto, right? It's the exact same paradigm over and over again. It's like, I'm going to give you some money. You're going to give me a portion of that back. But ultimately, it's going to race to zero. And I'm going to end up with a fraction of whatever I gave you. And this is exactly what was happening in blockchain gaming. Now, we were really hoping that there would be sustainable business streams that would power fundamentally the game. Because there are, and this is always the hope. It's like the hope drives you to believe that they'll fix the underlying problems in the economy, even if you identify those problems early. But then the reality sets in and it's like, oh, they didn't. Right? Well, right. Like, yeah, it's like the problems exist and those problems overtake the system. And then all of a sudden it's like, oh, it's a house of cards. Right. So
but they didn't fix it, or they couldn't fix it? Because I mean, if there's simply no, I mean, this was a big thing with Anchor protocol, right? It's like, oh, the sustainable yield would be like maybe 7 or 8%, which is, that already sounds pretty high. But then they're like, oh, but we're boosting it for marketing purposes. And I always thought, 7 or 8% doesn't sound so bad, but of course it's not 20. And then there's probably better offers somewhere else where you take somebody else's money. But I mean, what I'm trying to say is even getting to 7% sustainable yield, if that were the case, is amazing, right? That's way more than you get in a lot of places. But I guess in gaming, what are potential like real value creation mechanisms inside games? Is there such a thing as like virtual work, or like virtual, like how would that work? Like do you know of one or two mechanisms that actually create value that people would pay for? I mean, I'm not saying like not as much money to like quit your job and just play, but like any money.
Sure. So probably the most sustainable blockchain game in the world today, which is not super fancy but effective, is this app on the App Store called Bitcoin Miner. And in the Bitcoin Miner game, it's kind of like an idle clicker game. Like you are a Bitcoin miner, you're mining different cryptocurrencies. It's almost like a farm bill of Bitcoin mining. And they give you Satoshis for playing the game. Right. So as you're mining, you're actually mining Satoshis. Right. Now, well, I shouldn't say you're not actually mining Satoshis, but they're giving you Satoshis for playing this game. Now, naturally, your question should be, where are they getting the money to buy the Satoshis to give you to play the game?
Yeah.
And it's coming from advertising. So as you're playing the game, these ads pop up and it's like you're forced to watch it, blah, blah, blah. And then what they're effectively giving you is just a revenue share on the ads that you're watching. Right. This is the most sustainable blockchain game in the world today. Right. Like now that's at a very simple level of an economy that, functionally works, is sustainable, and you're not it's not a Ponzi, right? It's not like your Satoshis are going to disappear out of your wallet or something. So what are other more sophisticated, interesting systems? Because most people will listen to that like, yeah, that's not that interesting though. It's like it works, but it's not that interesting. There's a game out there called Neopolis, and in Neopolis, they turn the world around you into Monopoly. Right. So they like turn the environment around you and they cut it up into a board, and like you can build little buildings on the board around you and you can get income from that. And it's a total Web 2 game. You can download it on the App Store right now, Neopolis. And there's in-app purchases. The game is generating a significant amount of revenue. It by most metrics, we would say it's a successful Web 2 game. What are they doing? They're introducing land, but they're not introducing it in the way that you might think that they're introducing it. They're saying, look, this board around you, the world around you, you can now, instead of just putting buildings on the land, you can actually own the underlying land. So you can pay like $25 to own the land that's, on the McDonald's down the street from you, right? And if you own the land, it costs like, it doesn't cost very much to buy the land. But if you own the land and you build digital experiences on the land, and those digital experiences attract the Web 2 players onto the land to build buildings onto your land, we will give you a portion of the revenue that's coming from the Web 2 game, right? So the Web 2 players win because the Web 3 players are building experiences for them, right, that they're paying for, right? The game wins because now you're getting a bunch of user-generated content, right, from the Web 3 players. The Web 3 players win because they get to participate in a real money economy where they're actually being rewarded for their efforts, right? So this is real.
This is great.
Right?
This is very creative, for sure.
Yeah. So
very creative,
it's very creative. Yes, there are risks. It's not guaranteed to succeed. There's all sorts of problems that could be developed in the economy, whatever. But at the very base level of it, it is actually a sustainable economy, right? And so when we think about like more broadly, what are the, like, from just a basic level, what does a game need to do in order to actually in order to be a successful blockchain game? There's basically two things that the game needs to do. You need to create a game where players, one, want to own the assets to experience the game, and two, want to trade to enhance that experience. This is, like, at a fundamental level, you need to do these two things as a blockchain game. If you don't, then it's going to fall apart. Let's unpack it a little bit. Why do you need them to trade to enhance their experience? Because if you don't have trade, you don't have an economy. And if you don't have an economy, why the hell is there a blockchain?
Yeah.
Right? Like, you don't need a blockchain unless there's an economy involved of some kind.
Yeah.
Right. So at its base level, you need to be incentivizing players to trade to enhance their experience. And then the first point, it's like the players need to own the assets to experience the game. If the players do not own the assets, your incentive structures will always be wonky. Think about what happened with Axie, for example. Axie Infinity, for those that don't know, is one of the largest blockchain games in the world. It is what we built our guild on top of, right? So there were investors that wanted to buy the assets, but the investors' motive is to make money. The investors are not players. The investors don't care about playing the game. The investors are there to make money, right? The players take those assets and they play the game. But because the players don't own the assets, they're not interested in putting their own money into the game. All they're interested in doing is playing the game, earning money, and extracting that money out of the economy.
Yeah.
So now you have investors who are value extracting, you have players who are value extracting. Where's there going to be enough money coming into this ecosystem to combat all of this value extraction that's happening?
Right.
It's possible, but it's very unlikely. Right. So, the first rule here is you need players themselves to want to buy the assets, not to earn, but to experience the game. And that's super critically important. And that, like, once you get those two things, if you can do those two things at a really high level, you'll have a very successful game. And frankly, nobody's doing that at a high level today.
Yeah. I mean, there's this, I'm wondering if this goes together with, I mean, so what you said, right? There needs to be trade, because otherwise you don't have an economy. Then you don't really know a price, right? If there's no transaction, you don't really know a price for assets either. And then I guess from just like networks in general, I've learned that I mean, I guess it's a theory, but I guess it works sometimes. The total transaction volume times the actual value transacted is apparently an approximation roughly of the network value. And I wonder if that's, I mean, it's probably on some levels plays into that as well, right? I would assume.
Yeah, I mean, I think where that breaks down is like, okay, what's the value of Axie's network? Because that number is really high, right? But actually the value in Axie's network is very low right now.
Yeah.
Right. So this is the problem: is Ponzi's can look like they're doing a lot of significant transaction volume.
Yeah.
Right.
Yeah.
But that doesn't mean that the network is valuable.
Yeah.
And so this is like, I think that metric works if you have a sustainable system.
Yeah.
And like, we could argue what's sustainable, what's not sustainable, but ultimately we can all agree Ponzi's are not sustainable. Right.
No, for sure.
So this is, I think, a really important point is that we in crypto have been obsessed with creating zero-sum games. It's like various versions of I win, you lose. That's not how the real economy works. Right. The real economy is positive sum. The whole economy, most of the whole economy that you see around you is built on the idea that we can engage in trade and both of us win. You win and I win simultaneously. If it was zero sum, it would be highly problematic, right? You would get these problems where it's like, okay, everybody's basically dying and starving because the 8% of people that are sophisticated at trade are taking everybody's money, right?
Yeah.
And maybe you can argue that to a certain extent with income inequality, but like it's not that extreme, right? Most of trade today is positive sum. If you go to your mechanic to fix your car, you have money, your mechanic has the skills to fix your car. Your mechanic, doesn't need their skills for their own car. They've already fixed their car, right? Like you're gonna give them money, they're gonna give you their skills. You're both gonna be better off. You're gonna have a fixed car, they're gonna have monetized their skills, win-win, right? That's what most of the economy is, right? It's trade. It's win-win trade. In crypto, we're obsessed with zero-sum trade. We're like, somehow we have walked into this like bonanza casino where everybody's trying to take everybody else's money instead of figuring out how do we actually build really valuable use cases that encourage positive sum trade.
But I wonder if it's because of, I mean, on one level, because it's still small, right? So it's like, oh, there's just not enough interactions possible. So how am I going to create real value? I think that's probably what some people think. Then the other thing is, well, if I can, do it this way and make life-changing money for the founding team, then why wouldn't I, in a way? So it's like, but how do you, but then at the same time, I mean, there are projects that are building with a really long time horizon, I think, and you probably don't hear about them as much.
Correct.
For that reason, right? Because they're building
the bad actors that get the most press, right?
The nuts and bolts. Yeah, exactly.
And so, I've been pretty frustrated with, there's been a number of Web3 influencers that have gone on podcasts and they're asked a very simple question like, okay, what are the use cases for Web3? And they kind of like flub around and they just like dance around it and don't give really coherent answers or explanations. And that has been really frustrating for me to see because I'm like, it's pretty clear what the use cases are. Like there are dozens that I can name off the top of my head that are interesting, right? Like, for example, the fastest, easiest, cheapest way for me to send money to my family back in Iran is through Bitcoin. Like,
sure.
Like I can't do that through some wire transfer or ACH or Swift or any of that stuff. Like today, the easiest way to do it is through Bitcoin. And somebody might say, well, Iran is a sanctioned nation. It's like pick a different nation. And it's like, okay, well, I run a company where we have employees in half a dozen countries. And it costs me more than $60 to pay my Romanian iOS developer. It's cheaper for me to send him USDC on Solana than it is for me to pay him through a wire transfer. And it's like, you would only know that if you're meaningfully participating in the economy, right? But a lot of these people, it's like, it's all theory to them. It's all just like, oh, like we're all talking about these ideas. And it's like, no, actually live these things. And if you live them, the answers become obvious, right? It's like I was talking to Russian dissident journalists, and they were like, crypto has been a godsend for us because we can finally fundraise and not worry about like who's going to come after us and who's going to come after our donors, right? And even for the donors, it's like, cool, they can hide their identity when contributing to these causes that they believe in and not worry about retribution from some state government, right?
The regime.
So the regime, it's like there are so many. It's like if we had hours, I would sit here and give you all the use cases, right? And it's just ridiculous to me when I hear people not able to articulate why these things matter. They matter for so many reasons, right? And I think the use cases, there's so many.
Yeah, and it's exactly. So you named some big ones, but I think the point that we touched on earlier, right? It gives us a new sandbox to iterate quickly, and like, it's like, yes, with the caveat, we're speed running all the mistakes. However, I think to me, it's clearly visible that some of the solutions that are being developed are going, like, they're far superior than what we got going on. So I'm excited for that, right? To get into the mainstream, and of course it'll take time, right? But I think this boundless innovation, this almost like open source feeling that this brings is yeah, it's going to make waves no matter what. And
Well, I think,
yeah.
yeah, go ahead, Lovis.
No, sorry, go ahead.
Well, what I want to say is, I think it's important for people to understand the experiment that's being run here. The true experiment that's being run here. Like, for example, people ask me all the time, is crypto real money? And they're like, well, I can't go into Starbucks and pay with Bitcoin, man. It's not real money. And I look at them and I say, well, you can't go into a Starbucks in America and pay with Swiss francs or British pounds.
Right.
But both of those currencies are real money, right? Context matters a lot. And what cryptocurrency is the native currency of that particular blockchain. And those blockchains are actually digital nations. The currency has relevancy inside of the digital borders of that blockchain nation. If it happens to be that, the economic activity inside of a blockchain, inside of that digital nation, is so powerful and so interesting that it somehow spills over across the world, and one day you're able to use these native cryptocurrencies outside of their digital nations, then great, fantastic. Like, welcome to the free market. That's how it works. If there's a better solution, it will be adopted, right? But even if Bitcoin or Ethereum or any other cryptocurrency is never adopted in such a way that you could walk into a Starbucks and pay with it, it doesn't mean that it's a failure, because you have to look at the actual economic activity on that blockchain. So Ethereum is a nation, right? Avalanche is a nation. Solana is a nation. They have a population. We call them wallets. They have domestic trade. We call them smart contracts. They have foreign trade. We call them bridges, right? They have security. We call it Sybil resistance. They have voting. We call it consensus, right? They have many of the aspects that we see in proper nations, right? And the interesting part here is, can we build digital nations that have enough interesting use cases and economic activity and they're buzzing that they become viable infrastructures for robust trade across the world? And I think the answer is yes. Like, I think it's totally possible, right? We're not there yet today, but that's the experiment that's being run. And so, don't fool yourselves to thinking that for success to be reached, you have to be able to take Ethereum and pay at the grocery store. Like again, you cannot go to an American grocery store and pay with Russian rubles, or euros. Like, you can't do that, right? Like, those currencies have meaning in the economic systems that people participate in those regions. So, on the flip side, though, there are some currencies like the US dollar that become so powerful and proliferate so much that you can transact with the US dollar in many places outside of their borders. Could certain cryptocurrencies be as powerful as the US dollar one day, where they can be transacted outside of their digital borders? Sure. But that's not the success criteria for the cryptocurrency, right? Any more than that's the success criteria of a particular nation's currency.
Yeah, exactly. Well, so, I'm from Germany, currently living there, and I was in the US a couple of weeks over July and August, and I couldn't even purchase alcohol with my German ID, right? Because it had to be a US ID. Yeah. At least at some stores. I was like, all right, whatever. Here's my wife's. But yeah, Rockwell, thank you so much. This was, it was super interesting. I was on the edge of my seat, even though I'm standing the whole time. I really appreciate your time, and thank you so much for laying this out so beautifully. Yeah, it's been a pleasure. Have a good rest of the day.
Lovis, thanks for having me. And you really fooled me. I didn't know you were standing this whole time. Wow. Because you had a standing desk. Oh, wow.
Yeah.
All right, but we'll take care of yourself, and hopefully we'll chat again soon.
Absolutely. Thank you so much.
This podcast was not financial or tax advice. This channel is strictly educational and is not investment advice or a solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice. Talk to your accountant, do your own research. None of this is legal advice. This podcast is strictly educational. Talk to your lawyer.